Welcome to your daily Solo 401k webinar and Q&A session with my Solo 401k Financial, where we help you to stop overpaying taxes and start building real retirement wealth. Today's topic, Schwab Solo 401k. Sign up by December 31st and claim $1,500 in tax credits starting with your 2025 taxes. Please use the chat now to ask questions on today's topic or anything else. Please chat them over now so that we can be sure to get to them all. Let's get started. As always, the presentation is being provided for educational purposes only and should not be construed as tax, legal, or investment advice, nor as a solicitation. When making an investment decision, please consult with your tax attorney and financial professional. So the $1,500 opportunity is created by the Secure Act. In other words, the Secure Act created a number of tax credits to encourage small businesses to establish 401k plans. Now, one of those tax credits is not available to a solopreneur that establishes a solo 401k. Specifically, the startup cost credit would not be available to a solopreneur that establishes a solo 401k. But there's another credit that was authorized under the Secure Act, which is the auto enrollment credit. So a solopreneur, an owner-only business that establishes a solo 401k plan that includes the auto enrollment feature and the other required notices would be eligible to claim $1,500 in solo 401k tax credits. So this is the opportunity that is created under the Secure Act. So this is a $1,500 in tax credits, $500 per year for 3 consecutive years. This is a tax credit, not a tax deduction. So it's a dollar for dollar reduction in the tax liability. And that way it's much more valuable than a tax deduction. Now, the catch is that you need to have a solo 401k plan that includes the auto enrollment feature and the other required notices. The good news is that my solo 401k Financial automatically creates the documents, automatically drafts the solo 401k documents to include the required feature and the required notices that are needed to enable the solopreneur to be able to start claiming those credits. So all that's needed to be able to start claiming the $500 per year credit for 3 consecutive years when the individual files their 2025 tax return is to establish the plan in 2025. So all that's needed is that the individual needs to sign up in 2025 because we establish the plan within the same business day when someone signs up. Now, the Schwab Solo 401k problem is that you could go to Schwab and get a quote unquote free plan, but ultimately it's going to potentially cost you thousands in missed credits and other features. Why? Because Schwab Solo 401k plan doesn't include the auto enrollment feature, doesn't include the required notices. So there's no credit for establishing the Schwab Solo 401k plan. Moreover, you'll miss out on a lot of advanced features that cause many clients to sign up for our plan. We'll review those advanced features that are available under our Solo 401k plan, but not available under Schwab Solo 401k plan. So for example, the quote unquote free Schwab plan, the basic plan, has serious critical limitations. For example, the Schwab plan doesn't allow the individual to take a 401k loan. That's where you could borrow money from your solo 401k. It's not going to be considered subject to taxes or penalties as long as it's properly documented as a loan and paid back according to the loan terms. Whereas with the solo 401k plan offered by my solo 401k Financial, our plan does allow the individual to take a solo 401k loan. Moreover, we prepare the required loan documents as an optional free service for our customers. In other words, no additional charge. Other features that are not available with the basic Schwab plan, but are available with the plan offered by my solo 401k Financial include the ability to make mega backdoor Roth solo 401k contributions. So that's a very popular feature that would allow someone to save, for example, up to $70,000 or more if they're age 50 or older for 2025, where the funds will end up in a Roth account. So you can't make mega backdoor Roth solo 401k contributions with Schwab's plan, but you can make those contributions with the plan offered by my solo 401k financial. No alternative investments. So with Schwab's basic plan, you're going to be limited to certain investments that are available at Schwab. That means you cannot make alternative investments. So no private placement, no real estate, no crypto. Whereas with the plan offered by my solo 401k financial, you can most definitely invest in those types of alternative investments. So it allows for that true diversification. And then lastly, of course, the plan offered by my solo 401k financial will enable the self-employed individual to claim those $1,500 in solo 401k tax credits, whereas the Schwab plan doesn't include the required feature. So those tax credits are going to more than cover our fees for the first 7 years. We charge $650, which includes the $525 establishment fee, plus the first $125 annual fee. Then starting 12 months later, we charge our $125 annual fee that covers the second year. So if you added up all of our fees over the first 7 years, it wouldn't even amount to $1,500. So features, again, that the standard plan lacks: the mega backdoor Roth, alternative investments, the solo 401k loan. These are some of the top features. And then, of course, the tax credit. Now, what's great is that we're neutral as far as where the accounts are opened. And Schwab, even though their basic plan will not allow for these advanced features, does not support the tax credit, they will still open up accounts for third-party plans that do support the tax credit, that do support the advanced features. So you can have your cake and eat it too. You can have the advanced features, you can qualify for the tax credit, but still have your accounts at Schwab. So the key to understanding is that a solo 401k plan is really a legal entity. So it's technically a trust. Like any legal entity, it's the documents that create it. So you can obtain the documents to create the plan for my solo 401k financial, and then use the documents to open up accounts at the bank or brokerage of choice, including Schwab. So the first step would be to get your plan, get the documents, which again, we prepare the documents within the same business day. And then, of course, you need the documents that include the auto enrollment feature, which we automatically prepare the documents to include that feature. It's also noteworthy that the tax credit is not just available to new plans, but also pre-existing plans that are upgraded to our plan will also be eligible for the tax credit. So it's very common, for example, that someone might want to upgrade a basic plan. It could be a basic plan at Schwab or a basic plan at Fidelity or somewhere else to our plan to take advantage of the features to qualify for the credit. Then step two, open up the accounts at Schwab. So here you're opening up brokerage accounts at Schwab that are governed by a third-party plan. So you're not creating the plan documents with Schwab, you're just opening up the accounts at Schwab. And what's great is that we're very hands-on in helping our customers open up accounts at the bank or brokerage of choice. So for example, with Schwab, we pre-fill the paperwork that Schwab requires to open up free brokerage accounts that are governed by our plan documents. Finally, step three, when it comes to the credit and funding the account, would be funding that account, claiming the credit. Now, in terms of contributions, as long as the individual signs up by the end of the year, they'll not only be able to start claiming those $500 per year credits when they file their tax return next year, they'll also preserve the ability to make all types of contributions for 2025 by the business tax return deadline, including extension in 2026. So that means they can take their time to open up accounts, to make contributions, etc. It's also noteworthy that we provide a link to a deep dive webinar that we hosted with an IRS enrolled agent that goes through step by step how to complete that short 2-page form 8881 that's needed to claim the credit. So a lot of customers will simply share that deep dive webinar that we hosted with an IRS enrolled agent with their tax advisor so that the tax advisor can be sure to file the form 8881 and they can claim the credit. Again, starting with the 2025 tax return, as long as they sign up here by the end of the year. So the critical deadlines are to sign up by December 31st. That'll not only preserve the ability to start claiming those credits when you file your tax return next year, but also preserve the ability to make all types of contributions, whether employee, employer, and or voluntary after tax, which is how you make mega backdoor Roth contributions, by the business tax return deadline, including extension in 2026. It also means you can take your time to open up accounts until 2026. So that takes us to the end of the slides that we wanted to share. Thank you so much for checking out today's session. Now let's turn to the questions that are being chatted up. If you have more questions on this topic or even unrelated topics, we want to use the time to answer your questions. So please don't hesitate to chat over questions. So from AA, if you're truly a one-person show, would you only qualify for the startup credit? So that's a common misunderstanding. There are 2 credits that are authorized under the Secure Act. And if you read a lot of publications about that online, you'll see that the authors are conflating the credits. And so they are 2 new credits, 2 different sections of the code, 2 different qualification requirements. And it's clear under the IRS Form 8881 instructions that in order to qualify for the startup credit, you need to have a non-highly compensated employee. So you have to have an employee, which by definition, a solo 401k owner will not have any non-owner, non-spouse employees. So that means that a solo 401k owner would not be eligible for the startup cost credit. However, there's that second credit, the auto enrollment credit, different qualification requirements. It's clear under the instructions of Form 8881, the IRS form that's used to claim the credit, that in order to qualify for the auto enrollment credit, there's no need for a non-highly compensated employee. Therefore, a one-person business that has a one-participant plan that sets up a plan that includes the auto enrollment feature is eligible to claim those credits. And what's great is that unlike the startup cost credit, which as the name implies is a function of the costs, the auto enrollment credit of $500 is not limited by the costs. So even though it costs, even though those $1,500 in credits is going to more than exceed the cost to set up and maintain the plan with my solo 401k for the first 7 years, you're not limited. You can still claim the full credits. So as long as you sign up by December 31st of 2025, you will preserve the ability to make all types of contributions for 2025, whether employee, employer, or voluntary after tax, by your self-employed business tax return deadline in 2026. That's another reason to sign up before the end of the year. All right, next question is from Tom. So yes, if you upgrade your plan here in 2025, then you could start claiming the credit when you file your tax return next year. But you could also choose to wait until 2026, in which case the 3-year period would start with the 2026 tax return. No, the plan number would not change. It would remain 001. So yesterday, yeah, thank you so much for coming back. So Roy, with the good question. So we're neutral as far as where the accounts are at. So whether they're at Altruist or Schwab or Fidelity. So customers open up the accounts, meaning the plans with us, and then use the documents to open up the accounts at the bank or brokerage of choice. Again, we're very hands-on in opening up those accounts. Whether that third party will charge fees is up to them. Generally speaking, they're not charging fees. Altruist, in our experience, does not charge fees to open the account. Schwab, Fidelity doesn't charge fees to open the account. Now, whether they have transaction fees or fees for certain investments, that'll be up to that provider. Great question. Thank you so much. Yes, our plan document does allow for investing in options. Now, some of the considerations will be whether the specific financial institution where the account is at will allow you to open up an account for a third-party plan that can invest in options. Based on experience, Schwab will, Interactive Brokers will. Now, sometimes they'll limit the level based on the specific underwriting of that customer, right? Or generally speaking, they may limit it to level one options. But broadly speaking, yes, the plan does allow for investing in options. Now, another issue that sometimes comes up with options is margin. So if you're making an investment on a margin basis, that doesn't mean that it's prohibited, but a tax may apply to the income derived from that debt financed investment, which is referred to as unrelated debt finance income tax, which would be payable by the 401k. So that's another issue that sometimes comes up for those that are looking to invest in options. Is it possible for me to roll over my Roth money from my solo 401k to my Roth IRA? Yes, it is possible. However, if the funds are being transferred from the Roth solo 401k out of the plan to a Roth IRA, a triggering event will need to be met, generally speaking. For example, you got to be at least 59 and a half years of age. Now, one exception to that general rule is voluntary after-tax contributions, which are technically not Roth contributions. They're a different type of contribution, but that is how one makes mega backdoor Roth solo 401k contributions. So our plan does allow, of course, for voluntary after-tax contributions because that is how one makes mega backdoor Roth contributions. And when you make a mega backdoor Roth solo 401k contribution, it's a two-step process where the funds are first deposited into a voluntary after-tax account before they're moved either to a Roth solo 401k or a Roth IRA. So if you really want to have funds accumulate in a Roth IRA, the mega backdoor Roth can be an option where you decide instead of transferring those voluntary after-tax funds to a Roth solo 401k, transfer them out of the plan to a Roth IRA. It's also noteworthy that regardless of whether the funds are transferred to a Roth solo 401k or a Roth IRA, it's going to be reportable by the plan, needs to be reported on a Form 1099-R. And we handle that reporting as an optional free service for our customers. Customers just have to let us know. They let us know by using one of the online forms on our website that you can access 24/7 at mysolo401k.net/forms. Yes, we automatically draft a document to include the auto enrollment feature as well as the required notices. Whether we're upgrading an existing plan or creating a new plan. So if it's 100% cash, meaning there's no debt, there's no margin, then that is not going to be an issue that triggers UDFI, unrelated debt finance income tax. I understand you're asking about a situation where there would be no um, margin on the investment. That's a great question. So generally speaking, the voluntary after-tax contribution limit applies at the plan level, just like the employer contribution limit applies at the plan level. Whereas the elective deferral limit, the employee limit, for example, of 23,500, applies at the employee level. So even though someone may max out their contributions to their day job 401k plan, that's not going to prevent them from maximizing the voluntary after-tax contributions to the solo 401k. So as long as they have the self-employment income to justify it, the fact that they made those day job 401k contributions is not going to prevent them from making a $70,000 voluntary after-tax contribution to the solo 401k. But that's the general rule. The exception is the 403b exception. So all the contributions made to the 403b, whether employee or employer, together with any contributions that the individual would want to make to the solo 401k, the sum cannot exceed the overall limit. So if 23,500 between employee and employer is made to the 403b, that'll reduce by 23,500 how much can be contributed to the solo 401k. So it depends whether the successor trustee can take over. Certainly, the plan does allow for a living trust to be a beneficiary. It allows for designation of a successor trustee. But if the self-employed business that sponsors the solo 401k does not continue, then the plan itself will need to be eventually wound down. Could be handled by the successor trustee, and then the assets transferred out of the plan, for example, to inherited IRAs. If the business does continue to operate, let's say by a surviving spouse who then takes over as well as the successor trustee, then the plan could continue, and the successor trustee could continue to handle it going forward. It'll depend on the facts and circumstances. What is the max I can contribute? Those are great questions. All these questions. Thank you so much for the good participation. And now we've got a question from Mary Ann. What is the max I can contribute to my employer side of my solo 401k? I believe the max across my work 401k and solo 401k is 77,500 for a 57-year-old. Is that correct? If so, then I have approximately 15,500 to contribute to my solo 401k employer side by April 15th to be applied for the 2025 tax year. So first of all, thank you so much. Second of all, if you are self-employed with no non-owner, non-spouse employees working for any business owned by you or a spouse, if any, the fact that you've got a day job 401k plan won't prevent you from setting up a solo 401k. As long as you sign up by December 31st, 2025, you will preserve the ability to make all types of solo 401k contributions for 2025 by the business tax return deadline, including extension. So if your self-employed business is taxed as a sole proprietorship with the income reported on a Form 1040, the deadline, if you sign up by December 31st, will be April 15th of next year or October 15th if you file a timely extension for your 1040. Now, the max in terms of the employer contribution is 70,000. So the additional 77,500 that can be contributed because you're 50 or older, that's an employee contribution. That's a catch-up contribution made as an employee that could be made, for example, to your day job plan. So when you say that the max across my work 401k and solo 401k is 77,500, really it's 70,000, and that would apply to the employer contributions. That would apply to the voluntary after-tax contributions. Because like we talked about with the earlier question, the employee contribution limit applies at the employee level. And again, the catch-up contribution limit is a type of employee contribution. So let's assume, just for discussion purposes, that the individual maxes out their day job plan and they contribute 31,000 for 2025. They could still contribute another 70,000 as an employer contribution to the solo 401k, assuming they've got the self-employment income to justify the contribution. Remember, the employer contribution limit is a percentage of the self-employment compensation. So it's 20%, for example. So the individual would need 5 times that amount as self-employment compensation to justify a $70,000 employer contribution to the solo 401k for 2025. But if they did have that type of self-employment income, then yes, they could make a full 70,000, notwithstanding the fact that they maxed out day job contributions to their day job 401k. So you have contributed 31, so you maxed out the day job. So yes, you can, as long as you've got the income to justify it, you can make the $31,000. Now you cannot make a 31,000 employee contribution because the employee limit applies at the employee level, but you can make employer, you can make voluntary after-tax contributions. Here's more on the same question. Yeah, again, you cannot make a $31,000 day job employee and $31,000 solo 401k because that employee contribution limit applies at the employee level. But the employer contribution limit is not reduced by contributions made to a day job 401k plan, with the only exception being if that day job plan is a 403b, like we talked about with the earlier question. And again, the 77,500, that's a type of employee contribution. You already used that limit at your day job plan. You can't use it again to the solo 401k. What pool of funds does the after-tax contribution come from? It could come from a personal account or a business account. What's important is that you have the self-employment income to justify the contribution. You have a plan like ours that allows for voluntary after-tax contributions. The contributions are justified by the self-employment compensation. They're within the contribution limit. They're made to a separate after-tax account. So that's what's important, not so much where the funds are transferred from. In terms of determining your self-employment compensation for the self-employed business that's taxed as a sole proprietorship, like a single member LLC, you start with your net income reported on line 31 of Schedule C, less 1/2 of the self-employment tax. So you don't have to reduce it by FICA, for example. It's just less 1/2 of the self-employment tax. And then of that amount, the individual can contribute 100% dollar for dollar up to $70,000 for 2025 as a voluntary after-tax contribution. Again, needs to go into a separate voluntary after-tax account. And that, of course, assumes that they're not making any other contributions to the solo 401k because they're using the entire amount as a voluntary after-tax. I've been contributing the max allowable to my after-tax account based on Schedule C income, less 1/2 of self-employment tax. Is there any tax reporting for that? So remember, when you make a mega backdoor Roth contribution, it's a two-step process. You first deposit the funds into an after-tax account before they're transferred either to a Roth solo 401k or Roth IRA. So the after-tax contribution itself, that doesn't need to be reported. It doesn't need to be reported on the personal tax return or the business tax return. The subsequent, it's technically a type of employee contribution, but it doesn't need to be reported. What needs to be reported is the subsequent transfer from the after-tax account either to a Roth solo 401k or a Roth IRA. That needs to be reported by the plan. And we handle that 1099-R reporting as an optional free service for our customers. Customers just have to let us know about the transfer in a timely fashion by submitting the online form. All right, thank you so much for all the great questions. We ask you to please like and subscribe. Liking tells the platform that the content is valuable, which helps other solopreneurs like you find it. Subscribing guarantees you get notifications of all of our crucial content that we deliver every day to help you secure your retirement. So again, if this information is helping you feel more secure about your retirement, more confident about your future, please take 1 second to like and subscribe. Well, so in this case, it looks like so it's not reduced by the day job contribution as long as it was made to a day job 401k. You would be, it looks like you've made an employer contribution, an employee contribution, um, and then you could do the difference up to 70,000 as an after tax. Awesome. Thank you so much. We also invite you to our community. We have the largest community of solopreneurs, solo 401k owners with over 30,000 members. We have vibrant forums. We have a library of videos and webinars. So that means there's a ton of ways to learn and to share the knowledge. It's totally free to join. All are welcome, not just clients. You can join quickly and easily at mysolo401k.net/my community. So please don't hesitate to join. So if you contributed to your 457, contributions to the 457 they're not going to reduce how much you can contribute to the solo 401k. So that is correct. You send questions via email. Okay, so we'll be responding to that via email. But again, if it was made to, the question is whether it was made to a 403b or a 401k. If it's just a day job 401k contribution and it's going to, again, a 401k, that's only going to reduce how much you can contribute as an employee to the solo 401k, but it's not going to reduce the overall limit. It's not going to reduce the employer contribution limit. It's not going to reduce the voluntary after-tax contribution limit. A day job 401k. So that means that, so the employee limit, 23,500 for 2025, that applies at the employee level. The most that the person can contribute is 23,500. So if you fill it up at your day job plan, or if you make contributions at your day job plan, that's going to reduce how much you can contribute as an employee. So if you contribute 3,500 to your day job, the most you can contribute as an employee to the solo 401k is 20,000. But those day job employee 401k contributions do not reduce the employer contribution limit, do not reduce the after-tax contribution limit. That's what we were saying. If you max out your day job 401k contribution, but you've got $70,000 of side self-employment income, you could put the full 70,000 as an after-tax into the solo 401k, then transfer either to a Roth solo 401k or a Roth IRA. Hopefully that helps. Thank you so much for bringing all the great questions. That's it for today's solo 401k session. Thank you so much for investing your time with us. Your time is valuable and your retirement future is worth it. If you haven't yet, please like and subscribe so we can keep building this community. We'll be back here tomorrow with more crucial content to help you secure your retirement.